Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. But first, a look at the weather. Meteorologist Jamie Dimon upgraded his outlook to a hurricane warning, so I'll let you get back to your preparations. In the meantime, here are three things to take you into the weekend. This week, our three things are: 1. Growth shock. It's the new inflation. 2. ISM Manufacturing stops its skid. We have a non-consensus view. And 3. Consumer spending. BofA and Amex give fresh perspectives. All right, let's dig a bit deeper. So what happens after peak inflation? One of the things we researched in our KBRA Altman unit, and by the way, you can access KBRA Altman on our website, kbra.com, is what happens to credit when the Fed enters a tightening cycle. By now, you've heard that in the vast majority of cases, we end up in recession. That's true, but we found that conventional wisdom can be misleading. Eventually, we will end up in recession after literally any event. The key question for investors is when we do enter that recession. Oftentimes, it's as much as 2 to 3 years after the Fed begins to raise rates. Intuitively, this makes sense, right? The Fed tightens when the economy is running hot, when the labor market is tight, and when inflation is rising. Ordinarily, there is a lengthy runway toward that eventual recession when you want to be long risk assets. Calling the turn is the key to outperforming. So what do we look for in the turn? Well, we look for when inflation peaks and a growth shock takes over. When the Fed achieves its goal of tightening financial conditions and, ideally, engineers a soft landing. And needless to say, this cycle is different because we're coming out of a never-seen-before fiscal stimulus and monetary accommodation amidst a lingering pandemic and the outbreak of war in Europe. Although the data and surveys are still mixed, at least at the headline level, we get a distinct sense that investors are moving their focus from the inflation shock to the developing growth shock. In other words, where the ravages of inflation, including Fed jawboning and actual tightening, are now tangibly impacting consumer and commercial sentiment. We see it in rising recession probabilities. By the way, Bloomberg's market implied model this week hit a 61% one-year likelihood. We see it in the plummeting Citi Economic Surprise Index. We see it in the falling Atlanta Fed GDP Now estimate. And we saw it in the first quarter earnings reports from Walmart and Target. Now, this is not to say that we believe we're falling off a cliff. With the jobs market as tight as it is, that is not the case. It simply means that confidence, be it on the part of the consumer, a business, or an investor, is falling, albeit from a position of strength. And what's noteworthy, if not odd, about this cycle is that this sentiment shift is taking place just when the Fed is beginning to tighten. Let's hope they monitor growth shock better than they did the inflation shock. All right, on to our second thing, manufacturing's last hurrah. In what is increasingly a downbeat economic drumbeat, bulls were energized this week with the ISM Manufacturing PMI surprising to the upside and firmly in expansion territory at 56.1. Remember, anything above 50 indicates expansion. In the interest of curbing your enthusiasm, we were at a 38-year high back in March of 2021 when the reading hit 63.7 and have been skidding ever since, but the May result was an improvement over the April reading. In the latest reading, the new orders and production components unexpectedly bounced higher, so all is well. Or is it? We care because the ISM Manufacturing PMI correlates positively with the price performance of risk assets rather nicely, something that makes intuitive sense. Now, in the May report, the inventories element jumped up to its highest level since November of 2021, continuing a string of well above average readings of late, a clear indication of manufacturers ramping up production to meet the recovery. When ISM respondents were asked if inventories are too high, just 13% came back and reported yes. That need to build inventories ties into the massive import figure in the most recent GDP report. We're struggling to meet demand here at home, so we import the balance, all in expectation of strong demand continuing. This narrative also is consistent with what we heard at the micro level from Walmart and Target, which reported a surge in inventories. But that's where the concern arises. The retailers found themselves unable to move as much higher margin goods because their shoppers were spending more on staples. Both retailers pointed to growing conservatism on the part of their customers. In other words, the seeds of a growth shock are beginning to sprout. The risk to manufacturers is a timing mismatch between production ramping up as demand falls away. And by the way, that will only get worse when China comes fully back on stream. Now that implies a return to the skidding trend in the back half of the year in this all-important benchmark. Maybe that's why the employment component of the latest ISM was relatively weak. Of the 18 manufacturing industries, only 8 reported employment growth. That could be the ongoing labor shortage, job openings hit a recent high in the sector, or growing conservatism on the part of factory managements. Neither is good for economic growth or, in turn, corporate earnings growth. Watch this space closely. All right, on to our third thing, the durability of consumer spending. When thinking about the future, market participants are clearly dividing into glasses half full versus half empty camps. The half full crowd sees strong ISM results, a tight job market, and still solid, if not profligate, consumer spending. The half empty crowd is focused on the ravages of inflation, a way behind the curve Fed, and detrimental geopolitical impacts. These are all powerful cross currents. As we've said many times in the past, we are indeed in uncharted waters. Now, one thing that is less debatable is the strength of the U.S. consumers. In general, they are securely employed, their balance sheet is in great shape, and they have the wherewithal and the willingness to continue to spend even with everything costing more. When you listen to fresh commentary from 2 CEOs that have a pretty good view of the consumer, Brian Moynihan at Bank of America and Steve Squeri at American Express, you come away feeling like, yeah, the glass is half full. At Amex, consumer travel is 40% above pre-pandemic levels. Goods and services spending was up 21% in Q1, and that momentum is continuing. The wealth effect of the stock market correction has not impacted spending, according to Mr. Squeri. He also observes, quote, "We can talk ourselves into a recession, but I'm just not seeing it with the card base," unquote. At BofA, dollar spend in May was up 9 to 10%, and Memorial Day weekend spend was up 30% over 2019 levels. Transactions, which eliminate the effect of inflation, are up 8%. Mr. Moynihan notes that travel is good, restaurants are good, goods are down a bit, as expected. Customers have more money in their accounts than they did pre-pandemic by multiples. They got plenty of money to spend. They'll spend it down, but it will take a good while. Willingness is very strong. So for these massive players in consumer payments, the glass is definitely half full. But at the risk of stating the obvious, these 2 players are overwhelmingly upscale financial services providers. The color coming out of them is important because their core customers account for a disproportionate amount of total consumer spend. So that bodes well for 2022's economic growth. But a couple of cautionary words. 1, upscale consumers do pull back if they feel less secure. And 2, middle to lower income cohorts will be vulnerable here, particularly as they face the tax of higher inflation. Still, in the aggregate, it is difficult to count the U.S. consumer out when they are in as good a shape financially as they are. Here's another way to think about it. One-year recession probabilities have definitely risen to, on average, 30%. That means that the consensus believes there is a 70% chance of economic growth continuing, and that should be constructive for credit spreads holding near historic averages over the balance of the year. So there you have it. 3 things in credit. 1, growth shock. It's underway. Test your portfolio for durability. 2, ISM Manufacturing stops its skid. Inventory build suggests that might be temporary. And 3, consumer spending. It takes a while for sentiment shifts to turn into a real headwind. As always, Thanks for joining us. Don't forget to check in on KBRA.com for our latest research and ratings reports. See you next week.